everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 6. This lecture is in continuation with lecture number 4 and 5, in which we discuss the chapter number 2, unit number 1, that is in the AS1, the concepts and the examples of ICAI. Now, in this particular lecture, we will be discussing ICAI illustrations and question and answers of the chapter 2, unit 1, that is in the AS1. Okay, now being a professional, a question will definitely hit your mind, which is like, give me one damn reason why should I study these question and answers, why should I watch this video? Because it is about question and answers. Okay, let me make it clear that these examples, these question and answers are nothing else but the practical examples. This will definitely help you in understanding the index and application of the same to your balance sheet and P&L. Okay, so this gives you a practical insight. Okay, so please don't skip this video, definitely watch it. Being a professional, you do not have to take the pain of learning all these questions, but being a student, you have to learn this throughout. Okay, take out page number 23 of your module 1, 23, 2.23. Okay, in case if you do not have access to question and to these modules, okay, what you can do is either you can go to ici.org and BOS portal. From there you can access it. Otherwise, the same are uploaded on our app as well. You can download it from there. Okay, let's begin. Keep your mind cool, calm, open, blank, and then study. Okay, you will be in a position to learn this better. Let's begin with question number 1. Illustration 1, page number 2.23. Let me know in case of doubt. An entity prepares its financial statement that contain an explicit and unreserved statement. What does this mean? You know that while discussing the concept, we have heard that explicit means separate statement, unreserved means without any if but, without any sort of exception. If a management is making an explicit and unreserved statement of compliance of Ind AS, however, the auditor's report on those financial statements contain a qualification. The auditor's report contains a qualification because of disagreement on application of one of the accounting standard. You know this, even though there is disagreement on the application, then also what do? We consider such financial statements compliant of Ind AS unless and until the management is stating what? That they have complied to all Ind AS. A condition is that the management should clearly, explicitly and unreserved statement should be presented, provided by the management, stating that they have complied to all the Ind AS. Such a disagreement between auditor and the management will not amount to the non-compliance of Ind AS. Okay, such a disagreement will not be said that just because of such disagreement between auditor and management, we will not consider that such statements are not compliant with Ind AS. Okay, see the solution. If you are attempting any ICAI, if you are preparing for ICAI exams, then what you have to do? You have to observe these answer writing pattern very carefully, thoroughly. Okay, see, yes, it is possible for an entity to make an unreserved and explicit statement of compliance with Ind AS, even though the auditors contains a qualification because of disagreement on application of accounting standards, as there is a reason given, as the preparation of financial statements is the responsibility of management. The management has wholesale responsibility to prepare the financial statements, whereas auditor's responsibility is just to check those financial statements. Okay, the responsibility is of management, and if it has prepared and is stating a statement that they have complied to Ind AS, it will be considered as complied to Ind AS. Okay, in case the management has a bona fide, or you can say genuine reason to believe that it has complied with all the Ind AS, but it should be that the management is on their behalf is very much sure, is very much genuine, and is very much sure that they have complied to all the Ind AS. It can make an explicit and unreserved statement for the compliance of Ind AS. Let's head towards illustration number 2. Next, entity XYZ is a large manufacturer of plastic products for the local market. This is a little big question, okay, and a case study based question is there. So please don't get afraid by reading such a big question. How will you handle it? The bigger the question, the easier it is, because it states all the facts and figures, and it makes you very much clear that at what point it is aiming and what conclusion you have to derive. Okay, so it pretty much describes itself. You just have to read it carefully and with a calm mind, okay, open mind. Entity XYZ is a large manufacturer of plastic products for the local market. On 1st April 2006, the newly elected government unexpectedly abolished means remove all import tariffs. Okay, the government has been newly appointed, new government has come in force, and they have removed the import tariffs, the import duties. Okay, that's how the import becomes cheaper. Okay, so including the 40% tariff on all plastic products. Such companies plastic product manufacturer, and now imports of plastic products have become cheaper. Many other economic reforms implemented by new government contributed to the value of the country's currency, rupee appreciating significantly against most other currencies. The currency appreciation severely reduced competitiveness of the entity's products. Okay. Before 2006, entity XYZ was profitable. What is the story? The XYZ used to be profitable. Now, since then, new government has come in force. Those have abolished, removed the import duties. That's how the imports have become cheaper, and that's how the company XYZ is unable to compete with the imports, and that's how there might be lesser sales, and that's how they can go into losses. The story is there. Okay. However, because it was unable to compete with the low priced imports, entity XYZ went into losses. As at 31st March 2007, entity XYZ equity was rupees 1000. During the second quarter of financial year ended 31st March 2007, the management restructured entity's operations. The restructuring helped reduce losses for the third and fourth quarter to rupees 400 and rupees 380 respectively. During the year ended 31st March 2007, an entity XYZ reported a loss of rupees 4000. Now, from becoming profitable, it went into losses of rupees 4000. In January 2007, the local plastic industry and labor union lobbied government to reinstate. They are requesting and asking to reinstate the import tariffs that were abolished earlier. Okay. At 10%. However, it emphasized that those tariffs would not be as protective, okay, as the tariffs enacted with the previous government, but yes, they will help them. In its latest economic forecast, the government predicts a stable currency, and secondly, it is predicting a stable currency. Okay, there will not be that their currency is getting less powerful, and that's how they will not be going into losses. Okay, so if the import duties are again reinstated, they will become a little more higher price, and the XYZ company entity will be able to compete. Secondly, the companies, the entities, the entire country's currency is not weakening. Okay, it will have a stable currency, and that's how it will somewhere protect XYZ from being shut down. Okay, you get this case? Exchange in the short term with a gradual weakening of the jurisdiction currency in the longer term. Management of XYZ undertook a going concern assessment. What is going concern assessment? Unless and until there is necessity to liquidate, or your intentions are there to liquidate, it will be considered as going concern. Unless and until you have either intention or there is necessity to liquidate. Okay. Now the entity XYZ is taking an assumption that is going concern. On 31st March 2007, management projects forecast that imposition of 10% on the tariff on the import of plastic products would at current exchange rate result in XYZ returning to profitability. This import tariffs will again make XYZ profitable. How should the management of entity XYZ disclose the information about going concern assessment in entity XYZ 31st March 2007 annual financial statement? Now see, let's see how it should record. We have to make a note that whether going concern assumption can be followed or not, whether when it is necessary or there is intention to liquidate, then you cannot follow going concern assumption. Okay, so you have to check this. Other than that, you have to put a note in case if you feel that going concern assumption cannot be followed further or is in danger. Going concern is a general feature to be considered while preparing the financial statement. As per Ind AS 1, when preparing financial statements, management shall make an assessment on the entity's ability to continue as a going concern. An entity shall prepare financial statements on a going concern basis unless and until the management either intends, it has intentions to liquidate, or the entity ceases trading, or third, there is no realistic alternative but to liquidate. But to do so means but to liquidate. There are no other possible chances other than liquidating the entity. When management is aware in making assessment of material uncertainties relating to the events or conditions that may cast significant doubt upon the entity's ability to continue as a going concern, the entity shall disclose those uncertainties. What it is said, that in case if there are any uncertainties that will put the going concern assumption into danger, then you need to assess, the management needs to assess such uncertainties and disclose those uncertainties. Disclose. An entity is required to disclose the facts in the financial statement are not prepared as on a going concern basis, along with the reason. They have to disclose this fact as well as the reason. They have to disclose the fact that these financial statements are not prepared as per going concern, as well as they have to give a reason as to why the financial statements are not prepared as going concern basis. While assessing the going concern assumption, an entity is required to take into consideration all the factors covering at least but not limited to 12 months from the end of reporting period. At least they have to look forward that next 12 months the company will not shut down. At least 12 months must be assessed, not lesser than that. On the basis of Ind AS 1, the facts and circumstances of the case, the following disclosure is appropriate. In disclosure, what do you need to do? You have to make a disclosure of the fact that such financial statements are not prepared as per going concern. Secondly, you have to state the reason why they are not prepared. See, read this note. This is the answer. On the basis of management's assessment on 31st March, the financial statements have been prepared and on the going concern basis. However, the management's assessment assumes that government will reintroduce limited plastic import tariffs and the currency rate will be stable, will be constant. On 15th March 2007, the government announced that limited import tariffs will be imposed in 2008 to up to 10%. However, the government emphasized that the market would not be as protective as the 40% tariff in effect before 2007. As for the previous government, it was 40% tariff. Now it will be reinstated 10% tariff, but it won't be equal to 40%. It won't be as protective as 40%. Provided that rupee does not strengthen, management projects forecast that a 10% tariff will on all plastic products would result in entities XYZ returning to profitability. As at 31st March 2007, entity XYZ had net assets of rupees 1000. If import tariffs are not imposed and currency exchange rates remain unchanged, entity XYZ limited liability could exceed its assets by the end of financial year 2007-2008 on the basis of their assessment of these factors. Management believes that XYZ is a going concern because of two reasons: because reinstatement of import tariffs will make it profitable again, and secondly that the currency rate is stable. These two important facts will support their going concern basis. But in case of any uncertainty, they have to disclose the effects of those uncertainties as well. Let's head towards next question. Examples we have already read. Illustration number 3, page number 2.28. Is offsetting of revenue against expenses permissible? Is it? We said that normally all expenses, incomes, assets and liabilities should be shown separately. No offsetting is allowed unless and until permitted by Ind AS. So it is asking that permissible in case of company acting as an agent and having sub-agents with commission, where commission is paid to sub-agent from the commission received as an agent. For example, you are an agent and you are receiving, for example, 100 rupees. And further you are diverting the same work to sub-agent and providing them rupees 75. So this is your income and this is your expense. So the question is that whether you should just net them out and show 25 rupees as your income, or what you should do, you should show all rupees 100 as your income and show 75 separately as your expense. See, the net effect will be same, but it is all about presentation and giving the right right picture. Okay, so it is said that unless and until it is permitted by specific Ind AS and all, okay, specifically all incomes and expenses should be shown separately. On the basis of the guidance regarding offsetting, net presentation in the given case would not be appropriate. Net presentation would not be appropriate, and it would not reflect the substance of the transaction. It would not be showing the correct picture of the transaction, would detract from the ability to understand the transaction. Accordingly, the commission received whole 100 rupees should be shown as income, and the 75 rupees should be shown as expense. Okay, the expense and income should be recorded separately. The gross income should be recorded without any deduction of the amount that you have paid to sub-agent. Gross revenue of the company, the amount of commission paid by it to the sub-agent should be considered as an expense and should not be offset against commission earned by it. Next, illustration number 4, page number 2.30. A retail chain acquired a competitor in March 2001 and accounted for the business combination under Ind AS 103 on a provisional basis in its 31st March 2001 annual financial statement. The business combination accounting was finalized in 2001 and 2, and the provisional fair values were updated. As a result, the 2000 and 2001 comparatives were adjusted. See, you have acquired in 2001. Okay, you have acquired in 2001. See, you have acquired in 2001 and accounted such business combination. Now, the business combination accounting was finalized in 2001 and 2. Okay, in 2001 and 2, and the provisional fair values were taken as comparatives. Now, it is asking that does the restatement require an opening statement of financial position, or that is an additional statement of financial position as of 1st April 2020. See, we are talking about 2001. The acquisition was done in 2001. Okay, so this is previous year, and the current year is 2001 and 2, in which all the calculations has been presented. Now, is it at all affecting or implementing or existing on the date of 1st April 2000? No, nothing was there. Okay, so therefore there is no need of showing the opening balances as on 1st April 2020. You have to show these for opening balances of the earliest period when and only when you have accounting policy change, and that too retrospectively. Okay, so that is known as additional statement. So such additional statement is not required because the acquisition had no impact on the entity's financial position on 1st April 2020. Now example number 8 and example 8, 9, 10. Illustration number 5. See, this is important. Even questions like this also come in further when we will be solving ICA questions. Now you know operating cycle, because we have learned that current and non-current, for current and non-current bifurcation, there was one criteria of operating cycle. If such particular asset can be encashed or a particular liability has to be set off within operating cycle, then also it will be considered as current. Okay, so how do you calculate operating cycle? You know, inventory holding period plus debtor collection period. See, the raw material period is 3 months plus work in progress and finished goods holding period. So this is what 3 plus 1 4, 4 plus 5 9. So 9 months is inventory holding period. Debtor collection period is 5 months. So 9 plus 5 equals to 14 months. Your operating cycle is of 14 months. Anything that is received within 14 months or has to be paid within 14 months will be classified as current asset or liability. Okay. Next, illustration number 6. Inventory or trade receivables of X Limited are normally realized within 15 months. How should X Limited classify such inventory, trade receivable, current or non-current? Current or non-current if these are expected to be realized in within 15 months. What is the inventory or trade receivables of X Limited are normally realized in 15 months. What is your operating cycle? Your operating cycle is of 15 months. Your operating cycle is of 15 months. Okay, is of 15 months. Wait, is of 15 months. Okay, and if you are realizing a particular inventory or trade receivable, you are encashing a particular asset within 15 months, then it is always current. Okay, and if no operating cycle is given, then you have to assume it as 12 months, even when you are applying the same Ind AS to your balance sheet, okay, to your practical financial statements. Next, Ind AS 7, illustration 7, B Limited produces aircrafts. The length of the time between first purchase of raw material to operating to make the aircraft that and the date the company completes the production and delivery is 9 months. Okay, from the first purchase to making and delivering the aircraft. The company receives such payment of aircrafts in 7 months. So you know, inventory holding period is 9 months. Debtor collection period is 7 months. So it becomes 16 months. Operating cycle is of 16 months. Anything that is received within 16 months will be termed as current. Okay. How should it treat its inventory and debtors? Operating cycle is of 16 months and inventory and debtors will be received within 7 months. The company receives payment for the aircraft 7 months after the delivery. So 7 months is lesser than 16 months, therefore it will be considered as current. The length of the operating cycle is 16 months. How come? 9 plus 7 months. Assuming that inventory and debtors will be realized within normal operating cycle, that is 16 months, both the inventory as well as debtors should be classified as current. Please let me know in case of doubt. Are you very clear? Because when we are making financial statements, you have to particularly clearly see that whether such a particular asset should be classified as current or non-current. And even this will help you while doing the transition from AS to Ind AS. You have to keep in mind which of the assets and liabilities should be reclassified, whether there is need to reclassify it as from current to non-current or non-current to current, because the criteria are different between the previous GAAP and the Ind AS. Okay. Same applies for liabilities. Illustration number 8. On 1st April 2003, Charming Limited issued 1 lakh rupee 10 bonds, 1 lakh issued 1 lakh rupee 10 bonds. Okay, there are 1 lakh bonds and each is of 10 rupees for rupees 10 lakhs. On 1st April each, your interest at the fixed rate of 8% per year is payable on outstanding capital amount of the bonds. That is, the first payment will be made on 1st April 2004. On 1st April each year, that is from 1st April 2004, Charming has a contractual obligation. Okay, it is as per the deal, as per the contract, and it cannot act in other than manner as prescribed. Okay, they have to act in the manner that have been dealt. Contractual obligation to redeem 10,000 of the bonds. Okay, out of 1 lakh they have to redeem 10,000 at rupees 10 per bond. In its statement of financial position at 31st March 2004, how should this be presented in the financial statement? See, there is 1 lakh rupee 10, that is 10 lakh worth bonds, and 10,000 has to be repaid, has to be redeemed. Okay, and 8% interest is there. How do you calculate? You calculate this 8% interest for the first year, and these 10,000 bonds as current. Okay, as current, these 8% interest for year 1 plus 10,000 bonds as current. Okay, and remaining remaining should be non-current. Are you clear? Read this solution. Charming Limited must present rupees 80,000, that is 8% into 8 lakh into 1 lakh, 8% into 10 lakh current accrued interest and 1 lakh current portion of the non-current current bond, okay, of this non-current bond as current liabilities. They should show these 8% interest on 10 lakh plus these 10,000 bonds of rupees 10, that is rupees 1 lakh as current liabilities, and the remaining 9 lakh should be are due later than 12 months and after the end of reporting period is presented as non-current. Are you clear? You are presenting the particular interest of the upcoming year as well as plus the amount that you will be paying the next year, first day of the next year. Okay, you are booking this amount, recording this amount as current. Other than that, the remaining amount is considered as non-current. Next, illustration number 9. What is the operating cycle? 3 plus 1 plus 5 is 9, 9 plus 4, 9 plus 5 is 14 months. Okay, the trade payables of the company are paid in 12.5 months. So the operating cycle is 14 months. If you are receiving anything or paying anything in lesser than 14 months, then it will be considered as current, even though it exceeds 12 months. Then also it will be considered as current. Please read the solution. In this case, the operating cycle of X Limited is 14 months. Since the trade payables are expected to be settled within the operating cycle, that is 12.5 months, they should be classified as current. Next, entity A has two different businesses, real estate and manufacturing. Real estate and manufacturing. Okay, so you know, if there are diversification in the business, okay, there are different lines of operation, then particular asset and liability for each and every line of business can be calculated on different basis. One can take liquidity basis, other than can take asset basis. Okay, so calculation basis can be different, presentation basis can be different, opted different. Okay. Now, real estate and manufacturing of passenger vehicles. With respect to the real estate business, the entity constructs residential apartments for customers and the normal operating cycle is 3 to 4 years. With respect to the business of manufacture of passenger vehicles, normal trade operating cycle is 15 months. Normal operating cycle is 15 months. Under such circumstances, where an entity has different operating cycles, see, you know that operating cycles for different lines of business can be different. It can vary from entity to entity, business to business, operation to operation. Of different types of business, how classification into current and non-current be made? See, there are two important points in this. Firstly, an asset should be classified as current if an entity expects to realize the same or intends to sell or consume it in its normal operating cycle. Similarly, as per para 69A of Ind AS 1, a liability should be classified as current if an entity expects to settle the liability in its normal operating cycle. In this situation where business have different operating cycle and classification of asset and liability as current and non-current would be in relation to the normal operating cycle that is relevant to that particular asset liability. It is advisable to disclose the normal operating cycles relevant to different types of business for better understanding. It is important to disclose the operating cycle. Okay. See, what you have to do is you can measure on different basis. Different business lines can have different operating cycle. So each of the asset that is related to a particular operation should be calculated, should be classified as current or non-current according to the operating cycle of that particular business line. Next, 11th. You know this, we have discussed this in the example as well. Same. Electricity deposit, tender deposit, GST deposit. Okay. You can read the answer. See, illustration number 12. An entity shall classify a liability as current when it expects to settle the liability in the normal operating cycle. An entity develops tools for customers and this normally takes a period of around 2 years for completion. it develops tools for customer that takes 2 years for completion. 2 years, 24 months is their basic completion of those tools. An entity develops tools for customer and this normally takes a period of 2 years for completion. The material is supplied by the customer and hence the entity only renders a service. The entity only renders a service. The tools are provided by the customer. What is this? This is like a job work. When a customer is providing their resources and asking some service to be done. For example, you have a cloth and you are submitting this, you are giving this to some party and some other third party and asking them to get it painted, dyed or printed, okay, or cut, anything. You can ask any sort of service on your own material. This is a type of job work, okay. So this material is given by the customer. The material is given by the customer and the company, the entity about which we are talking, is just rendering the service that the particular customer wants. For this, the entity receives payment upfront and credits the amount so received to income received in advance, okay. They show it as a liability. Now, how should this income be recorded in the financial statement? Current or non-current? How should this income received in advance be classified as current or non-current? Okay. Now, let's see. Some current liabilities such as trade payables and some accruals for employees and other operating costs are a part of working capital. These are part of working capital and used in the entity's normal operating cycle. An entity classifies such operating items as current liabilities even if they are due to be settled more than 12 months after the reporting period, okay. Normally, even if they are due after 12 months, but they are used in normal trading, normal working capital cycle, normal operating cycle, then they will be considered as current liabilities. In accordance to the above, income received in advance would be classified as current liability since it is a part of working capital, which the entity expects to earn within its normal operating cycle, okay. Next, illustration number 30. Let me know in case of doubt, please, okay. Are you able to catch up? Is my speed slow, fast, or I'm skipping anything? Please let me know, okay. Because we have discussed all these things in your last 4th and 5th lecture and that's why I'm taking it a little faster, okay, at a faster pace. An entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. Prior to the end of the reporting period, the entity and the bank enter into an agreement whereby the existing outstanding loan will unconditionally roll into the new facility which expires after 5 years, okay. Now, which was payable within next 9 months, okay, this should be recorded as current, but there is an agreement now, a new agreement which says that the company has to not pay anything and it will be converted into another loan. It will be carried forward to another loan and which has a liability, which has a term of 5 more years. Now, is it payable after operating cycle after 12 months? Then such same thing will be classified as non-current because at this current point of time, immediately nothing is payable. In case if the bank said that we enter into an agreement, you repay the current amount, whatever is there, and I will sanction you the new loan. So, if you have to repay the current loan, if there is an liability to pay the current loan, then this will be considered as current, okay. This will be considered as current, but in the particular situation, the bank is not demanding any immediate payment. Instead, it is extending the year, extending the period, extending the tenure, and that's how it will be classified as non-current. Let's see what is the question. How should such loan be classified in the balance sheet of the entity? Non-current. Will the answer be different if the new facility is agreed upon after the end of the reporting period? Okay, after the end, so what you have to continue the classification of previous loan as well only. Will the answer be different if the existing facility is from one bank and the new facility is from the other bank? Yes, if first facility is of another bank and the new one is from some other bank, then the first one will be asking all the repayment, and that's how you have to repay immediate payment, and that's how it will be considered as current. See, let's see the answers. Firstly, the loan is not due for payment at the end of the reporting period, and that's why it will be considered as 12 months and it will be considered as non-current. Read this. Since it was not payable at the end of the reporting period because it has got an extension of 5 years, the entity and the bank have agreed to for the said rollover period to the end of the reporting period for a period of 5 years. Since the entity has unconditional right to defer the settlement of the liability for at least 12 months after the reporting period, the loan will be classified as non-current. Okay. Second one, whether there will be any difference in the answer if the new facility agreed upon after the end of reporting period. So at the time of reporting period, yes, the answer will be different if the arrangement for rollover is agreed upon after the end of the reporting period. Since assessment is required to be made on the terms of the existing loan facility, as at the end of the reporting period the entity does not have any unconditional right to avoid such payment, okay, and that's how it will be considered as current liability, okay, classified as current liability. Third part, will the answer be different? Will the answer to A will be different if the existing facility is from one bank and the other new facility is from another bank. Different banks, if different banks, then it cannot be treated as refinancing. Loan facility arrangement with new bank cannot be treated as refinancing, as the loan with the earlier bank would have to be settled, which may coincide with the loan facility arranged in the new bank. Okay, they will have to pay it. Since there is an immediate outflow, it will be considered as current. Okay, next, D part. Will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has the potential to refinance? You know that we have read this in the notes that only potential to refinance is not considered, is ignored, and the previous classification is continued. Please read the answer D. Yes, the answer will be different and the loan should be classified as current. This is because as per para 73 of Ind AS 1, when refinancing or rolling over the obligation is not at the discretion of the entity does not consider the potential to refinance the obligation and classifies the obligation as current. Only potential to refinance does not amount to reclassification. Okay. Illustration number 14. In December 2001, an entity entered into a loan agreement with a bank. The loan is repayable in 3 equal annual installments starting from December 2005. One of the loan covenants is that an amount equivalent to the loan amount should be contributed by promoters by March 24, 2002. Failing which the loan becomes payable. Okay, it should be contributed by the promoters, and if they are not doing, the loan becomes payable after that. As on March 24, the entity has not been able to get the promoter's contribution. On March 25, 2002, the entity approached the bank. Okay. By March 24, there is no contribution received. Okay, and so on March 25, they approached the bank and obtained an extension of up to 30 June. That is approximately 3 months more. 3 months more means it is lesser than 12 months. If such extension was more than 12 months, then you would have reclassified it to non-current. Since the extension is just for next 3 months, that means it becomes payable right after the reporting date within 3 months, and that's how it will be classified as current. Okay, as on March 30, the bank cannot demand immediate repayment during the grace period. During the 3 month, the bank cannot demand the repayment. The annual reporting period of the entity ends on 31st March 2002. Assume on 31st March 2002 how the entity should classify the loan. Secondly, assume that in anticipation that it may not be able to get promoter's contribution by due date in February 2002, the entity approached the bank and got the compliance date extended to 2002 for getting promoter's contribution. In this case, will the loan classification as on 31st March 2002 be classified different from A above? In first one, they are not getting the promoter's contribution, and that's how they have approached the next day to the bank and got an extension. In the second case, in the B case, what they are doing, they on the February, mid-February itself, they are in a position that they are expecting that they will not be receiving the promoter's contribution, and that's how they have gone to bank, approached bank and got an extension. See, let's read the answer. Provides an entity classifies the liability as non-current if the lender agreed by the end of the reporting period to provide a period of grace ending at least 12 months. Please be careful, at least 12. The grace period should be at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate payment. In the present case, following the default, grace period within which an entity can rectify the breach is less than 12 months, and that's why it will be classified as current. Okay, in next case, they have approached the bank before the declaration that they will be not receiving the promoter's contribution. Since they are expected that they will not be receiving promoter's contribution, they have taken action of extension. So, current or non-current is case of breach of a loan covenant or loan, you can say loan condition, and does not deal with the classification in case of expectation of breach. It deals with actual breach, only actual breach. Only actual breach will be entertained. Okay, no expectation of breach will be supported with any sort of change or disclosure, whether actual breach has taken place or not, to be assessed on 30th June 2002, that is after the reporting date. Consequently, in the absence of actual breach of the loan covenant as on March 31st, the loan will retain the classification as non-current. Since there is still not any sort of actual breach, and therefore the loan will be continued as non-current. Okay, illustration number 5. In case of actual breach only, there will be reclassification. OMN Limited has a subsidiary MN Limited. OMN Limited provides a loan to MN. OMN provides a loan to MN at 8% interest to be paid annually. The loan is required to be paid whenever demanded back. Whenever demanded back by OMN. Okay. How should the loan be classified in the financial statements of OMN Limited? Will it be any different for MN Limited? See, let's read the question. Let's read the answer. See, if the demand can be done anytime, any point of time, then it should be considered as current. But here there is a relationship of parent and subsidiary. If parent has invested something in subsidiary, it will not be withdrawing it, it will not be demanding back soon. Other than that, at the end of the year, they have to see whether it will be asking for the loan or not, whether there are chances or not. Okay, according to which current and non-current will be classified. The demand feature might be primarily a form of protection or tax-driven feature of the loan. Both the parties might expect and intend that the loan will remain outstanding. They are expecting and intending, since there is holding and subsidiary relationship. Okay, if there was no relation, there might be that the amount can be demanded anytime, and therefore it should always be classified as current. But here there is holding and subsidiary relationship. They are expecting and intending that the loan will continue to be there with them only for the foreseeable future. If so, the instrument is in substance long term in nature, and accordingly OMN Limited would classify the loan as non-current asset. However, OMN Limited would classify the loan as current if both the parties intend that it will be repaid within 12 months. Okay, if it is said that if both the parties agree that and expect that it will be repaid within 12 months, then current. If not repaid within 12 months, then non-current. Then it should be considered as regardless of the intentions of both the parties. The classification of the instrument could affect initial recognition and subsequent measurement. This might require the entity's management to exercise judgment. okay, which could require disclosure under judgment and estimates. It is saying that the entity has to apply their own judgment that whether it is expecting that such a particular will be demanded, will be received within 12 months. Yes, then current, not then non-current. Next comes illustration. I think the illustrations have ended. In case of any doubt, please let me know. Illustration number 16. A Limited prepared the following draft balance sheet as on 31st March 2001. Okay, so there are different sets of balance sheet given. You have to prepare it as per Ind AS 1. Okay, so you have to keep in mind how do you have to prepare that assets. Then assets, its first heading should be non-current and then current. Then in further, B part should contain equities and liabilities. First equity, then non-current liability, then non-current, then current liability. Okay, so you have to identify these accordingly and then classify this and present in a balance sheet. Okay, try this on your own. This is just a practice, just for a practice that how a balance sheet is prepared. You will learn this when we will be preparing and solving the question answers and preparing the balance sheet and P&L for that particular question. Okay, you will get this learnt. Okay, so no need to worry. Carve, you know. Now comes test your knowledge. You have to try this on your own as well. If you are attempting and preparing for exam, then you have to you have to go through these question and answers and carefully look for the answers writing pattern. Okay, see, question number 1. An entity manufactures passenger vehicle. The time between purchasing of underlying raw material and the date of entity completes the production and delivers to its customer is 11 months. This is inventory holding time. Inventory holding period is 11 months plus data collection period is DCP is 8 months. So this become total 19 months. Will the inventory and trade receivables be current in nature? So these are assumed that this will be received in the operating cycle, and operating cycle is 19 months and therefore they will be classified as current. Assuming that the production time was say 15 months and the time lag between the date and the sale of collection from the customer is 13 months. That means collection period. This means 28 months. And then also it will be considered as current. See, answer number 1. Page number 68, 2.68. Read, are to be classified accordance with the requirements of Ind AS, which provide that an asset shall be classified as current if an entity expects to realize the same and intends to sell or consume it in its normal operating cycle. So here it is of 19 months and here it is of 28 months. Okay, since these are classified, these are expected to be realized within operating cycle and therefore current, classified as current. Please read this answer. Let me know in case of doubt. Question number 64. Page number 64, question number 2. See, in December 2001, an entity entered into a loan agreement with a bank. The loan is repayable in 3 equal annual installments starting from December 2005. See, this is very much equal to that we have done in example. There was 15 lakh bonds were there, 5 lakh was payable and the 10 lakh was 10 lakh was recorded as non-current. The 5 lakh that was immediately payable within a year, then that was at the end of first year, this was recorded as current. So you will do a bifurcation. You will be doing a bifurcation of current and non-current. Okay. One of the loan covenants is that amount equivalent to the loan amount should be contributed by promoter. You have seen this, and grace period should be more than. If grace period is greater than 12 months, then current. Not greater than 12 months, then current. Okay. If greater than 12 months, then it will be considered as non-current. So this is same question is there. See, try on your own. Question number 3. Company A has taken a long-term loan from company B. In the month of December 2001, there has been a breach of material provision. You know that there is a car, if there is breach of material provision as per Ind AS. Okay, so Ind AS says that on correction of it before the approval of the financial statement, you will reclassify it as non-current. But IAS, that is International Accounting Standard, says that once there is a breach and it has converted from non-current to current, then even on the rectification, it will not be reclassified as non-current. It will completely continue to stay as current asset or liability. Okay. So the same, there is a breach of material provision, as a consequence of which the loan becomes payable on demand on 31st March 2002. In the month of May 2002, the company started negotiation with the company B for not to demand payment as a consequence of the breach. The financial statements were approved for the issue in the month of June 2002. In the month of July, both the companies agreed that the payment will not be demanded. If they have agreed that the payment will not be demanded immediately as a consequence of the breach material provision, advise the classification of the liability as current or non-current. See the answer. If there has been agreement that they will not be demanding, there is no immediate payment liability, then it will be considered as non-current. It will be reclassified as non-current. Okay. But if the breach continues and if it is not rectified, then as per Ind AS 1, it will continue to be current liability. Okay. This means that Ind AS has given a relaxation that on correction of the breach, it can be reclassified to non-current. After reporting date but the approval date of the financial statement for the issue, not to demand payment as the consequence. Therefore, the grace period should be at least 12 months, less than 12 months, current, greater than 12 months, non-current. Okay. So, after the reporting period, the entity can rectify the breach. They can rectify the breach. And lender cannot demand any sort of immediate payment. In the given case, company B agreed not to demand payment but only after the reporting date and the financial statements were approved for issuance. The financial statements were approved for issuance in the month of June, and both the companies agreed for not to demand payment in the month of July. See, after approval is after it. If it is after approval, it should be, if it is after approval, then not considered. It should be before approval. Before approval of FS, then only it can be considered. Okay. Although the negotiation started in the month of May 2002 but could not be agreed before June when financial statements were approved, and therefore should be classified as current. If such rectification has been done, if such deal has been done and the amount will not be now demanded, has been agreed upon, dealt in before the approval of financial statements, then only such classification can be reclassified again back to non-current. Otherwise, the current classification has to be continued. Okay. Now, let's do illustration number 4. Page number 65, 2.65. An entity A has undertaken various transactions in the financial year ended 31st March 2001. Identify and present the transactions in the financial statement as per Ind AS 1. Okay, these are the amounts that you have to prepare in the P&L. Okay, so you know income and expense statement. It has two parts, P&L and OCI. Do you remember this? So OCI has 9 items. You have to see, identify the 9 items. If any amount, then transfer it to OCI, and if such amount is not belonging to OCI, then what you need to do? You have to classify it to P&L. Okay. Now, remeasurement of defined plans. I told you there also that you have to learn these in the notes, these 9 items, learn. Okay, let's see, we will check one by one. Learn these. Okay, see, we'll see. Wait. Remeasurement of defined benefit plan. Remeasurement of defined benefit plan is OCI item. Okay, so here we will write this is OCI. Defined measurement, this is OCI. Okay, current service cost is P&L item. Is it there? No. Then current service cost is PL item. Change in revaluation surplus. Change in revaluation surplus. First point of OCI. OCI item. Gains and losses arising from translating the monetary asset in foreign currency. Gains and losses arising from translating financial statement of foreign operation equity. Is it given? No, it is not given. So therefore it is PL item. Gain and losses arising from translating the financial statement of a foreign operation. Translating the financial statement of a foreign operation. Yes, then this is OCI item. Are you able to catch up? Gains and losses from investments in equity instrument designated at fair value through OCI. At fair value through OCI of financial assets. See what is written. From investment in equity instrument. Okay, and what it is written over here. From investment in equity instrument. Okay, it is there, fourth point. So therefore this is OCI item. Income tax expense was not written, P&L. Share based expense, P&L. Okay, so this is how you have to present. You have to club all the P&L part in the under P&L and then put another heading OCI and then club all the figures of OCI under the OCI head. Okay, so this is how you have to do the question. Fourth one, if you have learned this list, then the question is very easy. And these all items, just you have to learn this right now for the exam purpose. Now, for each of the transaction, we will be reading in their respective Indian accounting standard. Okay, we will be discussing each and every transaction and why its treatment is done in this way. We will be discussing in the respective Indias. Okay, why it is done, how it is done will be better discussed while understanding the specific Indias. Okay, right now only overview is given. Now next example. XYZ Limited, the company, is into the manufacturing of tractors and tractor parts and mainly supplying the components to original equipment manufacturers. The company does not have any subsidiary, joint venture or associate company during the preparation of financial statements for the year ended 31st March 2001. The accounts department is not sure about the treatment presentation of below mentioned matters. Accounts department approached you to advise on the following. Okay, you are preparing tractor parts. Firstly, there are qualifications in the audit report of the company with reference to two Indias. So we will say that yes, still you can present a statement by providing an explicit and unreserved statement that they have complied to Indias, because reporting and preparing the financial statement is the responsibility of the management. Answer number 6th one. An entity may present a comparative information in the addition to the minimum comparative financial information. No, wait, sorry. 5.1. Yes, an entity whose financial statements comply with Indias shall make an explicit and unreserved statement that they have complied to all the Indias in the notes. An entity shall not describe financial statement as complying with Indias unless they comply with all the requirements of Indias. Okay, they have to comply with all the Indias. Now 69, 65. Question number 2. Is it mandatory to add word standalone before each of the component of the financial statement? No, we have to provide a word consolidated in front of every financial statement, but not standalone. Next, the company is Indian company and preparing and presenting its financial statement in rupee. Is it necessary to write in the financial statement that the financial statements have been prepared in rupee? I don't think so. But at the top of every column, you always write rupee in lakhs. You can mention that if required. Okay. Fifth, 2 and 3 we will be solving. No, but no need to disclose the financial statements that they are individual or standalone. Yes, inter alia states that an entity shall display the presentation currency, okay, as defined in Ind AS 21 prominently, and repeat it when necessary for the information presented to be understandable. On the top of every heading, you always write rupee in lakhs, rupee in crore, rupee in this, okay. So you have to mention the currency. Mentioning the currency is important, okay. Let's see the question number 4. 5.4, okay. The company had sales transactions of 10 related parties during the previous year. However, during current year, there are no transactions with 4 related parties out of aforesaid 10 related parties. Hence, company is of the view that there is no need to disclose sales transaction with these 4 parties in related party disclosures, because with these parties there are no transactions during the current year. See fourth. No, except when Ind AS permit to or require otherwise, an entity shall present comparative information in respect of the preceding period for all amounts reported in the current periods. An entity shall include comparative information for narrative and descriptive information if it is relevant to understanding the current period's financial statement. So they will be providing for the comparative statements of each. You know that even related party disclosures are made 2 columnar, previous year figures and current year's figures. So if you are related, they have to present it. They have to mention that in current year you have repaid this, not repaid this, done any transaction or not. If relevant, yes, you have to disclose it. Okay. And no, you do not have to disclose it except you are doing any transaction. If you are doing any transaction, then you do not need to present it or disclose it. Okay. Question number 6. There are only 3 questions remaining. Please watch the video till end. Complete the questions. A company presents financial results for 3 years. That is 1 for the current year and 2 comparative statements internally for the purpose of management information every year in addition to the general purpose financial statement. The aforesaid financial results are presented without furnishing the related notes because these are not required by the management for internal purpose. You know that complete set of information, complete set of financial statement will be known only and only when it has balance sheet, P&L, cash flow statement, change in equity and notes to account. Okay, so it has not prepared any notes to account because the management for internal purpose does not require it. But you know that Ind AS 1 is not applicable on interim financial statements. During current year, the management thought that why not they should present third year statement of P&L also in the general purpose financial statement. It will save time and will be available easily whenever management needs this in future. Okay, so there comes a word cross reference. If they are able to cross refer, then only it is okay. If they are not able to cross refer the particular information, for example, you said refer page number this, for example number this, refer module. If you do not have access to module, will such reference valid? Is such reference of any worth? Will such reference benefit? So this is known as cross reference. For cross reference, the particular person must have access to the particular reference reference content. With reference to the above background, answer the following. Can management present the third statement of P&L as additional comparative in the general purpose financial statement? If management, wait, we will see the answer of first. Yes, an entity may present comparative information and minimum comparative information to the minimum, additional can be provided, additional comparative information can be provided to the minimum that is required, as long as the information is presented in the accordance with the Ind AS. But every information should be provided as per Ind AS. This comparative information may consist of one or more statements referred to in para number 10, but need not comprise a complete set of financial statement. When this is the case, the entity shall present related note information for the additional statement, but they have to also write down this and disclose in the notes to account. Next, sixth question, second part. Sixth question, second part. If the management present third statement of P&L in the general purpose financial statement as comparative, is it necessary that this statement should be compliant of Ind AS? Each and every financial statement is analyzed in their own particular respect, that they should comply with Ind AS. But you know that Ind AS 1 is not applicable on interim financial statements. Okay, let's see. But each and every point that has been provided, any column that has been provided, has to follow Ind AS. Yes, as per, an entity may present comparative information in addition to the minimum statement required by the Ind AS, as long as the information is prepared in accordance with Ind AS. Okay. Can management present third statement of P&L only as additional comparative in the general purpose without furnishing other components like balance sheet, statement of P&L, statement of equity or financial statement? Yes, you know that even third balance sheet can be provided for P&L. In that case, providing the third statement is not necessary for balance sheet, statement of cash flow and statement of change in equity. Only third statement of P&L can work. Yes, they can be provided. An entity may present in addition to the minimum comparative financial statements required by the Ind AS, as long as the information is prepared in accordance with Ind AS. This comparative information may consist one or more statement referred to in paragraph 10, but need not comprise a complete set of financial statements. When this is the case, the entity shall present a note. If it is not providing complete set of financial statement in any case, then they have to provide a note for the same. See, if you want to provide any sort of additional information, you can provide. Okay, it is permitted. You can provide additional information to addition to the minimum information that you are presenting. Okay, that information that you are providing must be compliant to Ind AS, and the additional information must not be complete set of financial statement. Okay, third point. And fourth point, if you are not providing additional information as a complete set of financial statement, then you have to put a note for the same, that the complete financial statements are not provided for the additional information. Okay, 4 points you have to keep in mind. Next, seventh, an entity, a company preparing the financial statement for financial year 2001 and 2 erroneously booked excess revenue of rupees 10 crore. Okay, there is an error. The total revenue reported in 2001 and 2 was 80 crore. Okay, 10 crore have been excess revenue. However, while preparing the financial statements of 2002 and 3, it discovered that excess revenue was booked in 1 and 2, which it now wants to correct. However, management of the company is not sure whether it need to present the third balance sheet as additional comparative. Okay, so third balance sheet can be provided whenever you want, but for the correction of an error, it is never provided. You will come to know when you will learn Ind AS 8. There are some accounting policy, estimates and errors, and how they will be dealt. When additional information can be given, when not required. Okay, so whether it need to present, so we'll say whether it is need to present the third balance sheet as additional comparative. So additional comparative is only needed when you are changing your accounting policy retrospectively. Is it necessary to provide the third balance sheet at the beginning of the preceding period in this case? The company wants to correct the error by giving impact in the figures of current year only. Is the contention of management correct? Let's see. First of all, an entity shall present a third balance sheet as at the beginning of the preceding period in addition to the minimum comparative financial statements required by paragraph 38A if and only if, addition is required only if accounting policy changes there, that is retrospectively. And secondly, retrospective application, restatement or reclassification has material effect on the information, has material effect. See, there are two important points: retrospectively accounting policies change or material effect of the information in the balance sheet at the beginning of the preceding date. If it has material impact, then only they will be providing. Learn this. You have to provide additional balance sheet only and only when opening figures of the earliest period, only and only when two cases: accounting policy change retrospectively, secondly, material effect of such change is there on the beginning figures of the earliest period. Secondly, no management need not to correct the previous year figures to correct error, but need to not to furnish third balance sheet at the beginning of the preceding period. So the management need to correct the previous year's figures. They cannot impact the entire amount on the current figure itself. If there is error, you have to correct it. Okay, you have to put the impact on the previous figures as well. You cannot just correct the current period effect. Okay. Now, 8th question. Question number 8. XYZ Limited, the company, is into construction of turnkey projects and has assessed its operating cycle to be 18 months. The company has certain trade receivables and payables which are receivable and payable within a period of 12 months from the reporting date. So it has operating cycle of 18 months, but these are repayable within 12 months. Let's see. First one. The company has some trade receivables which are due after 15 months from the date of balance sheet. The operating period is 18. Will it be classified as current? Yes. So the company expects the payment will be received within the period of operating cycle. Yes. Then it will be classified as current. No issue. Second, the company has some trade receivables which are due for the payment after 14 months from the date of balance sheet. These payables fall due within the period of operating cycle. The company does not expect that it will be able to pay these payable within the operating cycle, because the nature of the business is such that the generally projects get delayed and the payments from customers also get delayed. Okay, answer 2. So yes, and it will be considered as current. No, the company cannot disclose these payables as non-current, and the company also need to disclose the amount that are payable within 12 months and after 12 months from the reporting date. Whenever there is expectation, or you can say ability to avoid payment, then this will not be considered as current asset or current liability. Okay, page number 8th question, third part. The company was awarded a contract of rupees 100 crore on March 31st, 2002. As per the terms of the contract, the company made a security deposit of 5% of the contract value with the customer of rupees 5 crore on March 31st, 2002. The contract is expected to be completed in 18 months. The operating cycle is 18 months. The aforesaid deposit will be refunded back after 6 months from the date of completion of the contract. You have to see whether it will be converted into cash within 12 months or within operating cycle or from the reporting date. So if it will be refunded after 6 months, that is within operating cycle. If yes, then current. Okay. Next, the company has also given certain contracts to the third parties and have received security deposit from them of rupees 2 crore on March 31st, 2002, which are repayable on completion of the contract. But if contract is cancelled before the contract term of 18 months, then it will become payable immediately. However, the company does not expect the cancellation of the contract. Generally, it is not expecting any sort of cancellation, but if it is cancelled before the contract term of 18 months, then such amount will become payable immediately. Okay. No, because the amount may be required to be paid before completion of the contract in case the contract is cancelled. Okay, so they are asking whether they can be classified. Then we are saying that no, because the amount may be required to be paid before completion. You will have to pay it before completion, as cancellation becomes payable immediately. See, it is written payable immediately. Okay, next question number 9th and last question. Is offsetting permitted under the following circumstances? Offsetting permitted or not? Expenses incurred by a holding company on behalf of subsidiary, which is reimbursed by the subsidiary, whether in the separate books of the holding company, the expenditure and related reimbursement of expenses can be set off. Answer 9.A. Arrangement. If the arrangement is to reimburse the cost incurred by the holding company on behalf of the subsidiary, the same may be presented net. Okay, it should be ensured that the substance of the arrangement in that the payments are actually in the nature of reimbursement. If reimbursement, then net. If reimbursement is there, then net can be done. If you are paying the same to some other third party, then net is not allowed. Okay. Whether profit on sale of an asset against loss on sale of another asset can be set off? No, it cannot be done. Okay, 9th. Because it will not be presenting the clear picture. So, present it separately if they are material. Next and last question. When the services are rendered in a transaction with an entity and services are received from the same entity, okay, rendered to an entity and received from the same entity, in two different arrangements, can the receivable and payable be offset? Okay, there is one party from which the entity is providing is doing transaction, and services are received from the same entity in the two different arrangements. So will they can be set off? Then we are saying that if the party is same and there are contractual liability, they are legally able in a position to legally enforce the same and offset the same, then only what can be done? Then only they can be shown as one and netted off, offsetted. Other than that, they should be shown separately. See, read the answer, last answer. Ind AS 1 prescribes that assets and liability and income and expenses should be reported separately unless offsetting reflects the substance of this transaction. In addition to this, as per paragraph 42 of the Ind AS 32, a financial asset and a financial liability should be offset if the entity has legally enforceable right to set off and the entity intends either to settle on net basis or to realize the asset and settle the liability simultaneously. If they have legal enforceable right to set off, second, if they have intentions to set off this asset and liability net, then only it should be offset, otherwise not. In accordance to the above, the receivable and payable should be offset against each other and net amount is presented in the balance sheet if the entity has legal enforceable rights to set off and the entity intends to do so. Otherwise, the receivable and payable should be shown separately. So you have to see that whether there are legal enforceable rights to set off, then only set off, otherwise show it separately. Talking about the two assets, you have to see that gain and loss on different assets should not be set off. Instead, it should be presented separately. Okay, so this is all about Ind AS. We have covered all the question and answers. In case of any doubt, please reach out to me. To enroll for whole course and to see all the new videos, you have to download the app. That is, the link for the same is given in the description box. Okay, see you in the next lectures. Till then, take care, be safe, stay tuned.